Welcome everyone to our second round of Dream for All. I would like to welcome our guest, Brenda Wyatt. I'll give her a minute to introduce herself. My name is Ria Cotton Landry. I am the broker owner of Cotton Realty. We cover all of Northern California and some parts of Southern California. And what we want to do today is educate our viewers, potential clients, people that may know someone looking to buy a house about the California Dream for All that many may have heard about that will be launching soon. They have a portal starting in April. And not only that, because there's certain qualifications that Brenda's going to go over this evening to qualify for the program, but we also want to see what other programs that Brenda has available for those that may not qualify for the California Dream for All. Brenda, thank you for being with us this evening. You want to just start by introducing yourself?
Yes, thank you, Ria. I appreciate you coming up with the idea of us doing a seminar to educate people on the Dream for All program. I am Brenda Wyatt, Oakland native. I have been a mortgage advisor for over about 17 years. And luckily, I was able to work with you in the early part of my career. I
Right.
work with lots of first-time home buyers, and I really focus on assisting clients either with complex income or down payment assistance programs. And so today I am happy to share some of the details of the Dream for All program, which will be, the portal will be opening April 3rd. We'll tell you how to prepare to have your name submitted. And then we're just going to give you a highlight of some other programs that are available. So thank you for joining us today.
Thank you, Brenda. And then we have a couple of our team members from Cotton Realty on the line. I also want to welcome Lenice Span. Thank you, Lenice, for being and joining us tonight. We also have Kendra Madison on, as well as Kaylee Mason. So we have our team in the house and we are ready to serve. So go ahead and take it from here. Are you able to share your screen with us, Brenda?
Yes, I will do that now. Okay, can you see my screen okay?
Yes.
Perfect. So today we will be taking our information from the source, the California Dream for All website. This website is open to the public. It's available for you to go in, and you can even sign up for updates on the website. So I'm going to go over the qualifications for the Dream for All Shared Appreciation Program. The website for CalHFA, that's the acronym for California Housing Finance Agency, is just CalHFA, hfa.ca.gov. And so we're going to focus on the eligibility tonight. The CalHFA Dream for All is a shared appreciation program. And what that means is that you share a portion of your equity with the state. They will give you 20% down towards payment or closing costs. You can see that here under program highlights, but it cannot exceed $150,000. So basically you can purchase a property with no money out of pocket. Now, some things to consider or some strategies. If you do have funds, you can take the 20%, apply it towards your down payment. You can cover the closing costs. You can talk to your agent about the ability to ask for a closing cost credit, or you can do 15% down and use the remaining funds for closing costs. So you have the ability to come in with funds if you so choose. It does not prohibit you from bringing in your own funds, or you can do 100% financing. So the thing that we love about this program is we have some flexibility. Now, excuse me, as a home buyer, you must register for a voucher because it is a lottery. Last time when they launched the Dream for All program, the funds only lasted 11 days. So with the lottery, the goal is to make sure that those that are in true need and support of assistance are able to get an opportunity to take advantage of the program. And in addition to that, the lottery will have geographic specific numbers so that one area of California does not take up all of the funds. So each geographic area will be allotted a certain number of participants in the Cal HAFA Dream for All program. And this time around, it is funded with $220 million. So while it was similar to that the first time, we do feel that it will last a lot longer than 11 days this go around. So eligibility, there's been some tweaks to the program. One of the borrowers must be a first generation home buyer. And what I'm going to do is just click on that guideline so you can see what that means as I'm going through it. But you must not, excuse me, you have to be a first time home buyer and a first generation home buyer. As a first generation home buyer, it's defined as a homeowner who has not been on title, held ownership interests, or have been named on a mortgage to a home within the US within the last 7 years. So you can't have owned a property or had your name on title within a 7-year period. So you can have owned in your lifetime, but just not within the last 7 years. And your parents cannot have owned. So this is the new piece that we're seeing with the guidelines. Your parents cannot have owned or had interest in a property in the US. And if your parents are deceased, they cannot have owned at the time of their death. Now, there is an exception for individuals who have been placed in foster care or institutional care within their lifetime. And so in the event that you meet that exception, you don't have to meet the first generation home buyer guideline. And feel free to jump in if you want me to expand on anything or if anything is unclear.
Okay.
So now we know our eligibility, that we must be a first-time home buyer. We must have meet the first generation home buyer guideline. If you are a couple and you're purchasing together, only one of you must meet the first generation guideline, not both of you. So that is good to know, and be sure.
Isn't that a big key, Brenda?
Yeah,
when they added that piece.
Yes, and I appreciate you clarifying that for me. Like, Brenda, just double check that. And so, yes, that is correct. Thank you again for that. Because it made me go.
No, yeah, I mean, because it's so important too, because you never know what makes up a household, right? And we don't know who might be looking to purchase together. It's not always just couples or married couples, and family, friends are now purchasing together, kind of in the house hack terms of things. So that's a very important note. And I don't know if it's mentioned, but this is just for single family.
It is for single family property, so you cannot buy a multi-unit. You can do a condo, townhome, but you cannot purchase units. We do have other programs that will allow you to buy up to a duplex using assistance, but none of them give you 20% down. So that is the trade-off. Now, another piece to eligibility is income. So I'm just going to click on the income limits because they're fairly generous. And the reason why I also wanted to share the exact site, because the income limit is for the city that you're targeting, not the city that you live in. So if you live in, the county that you're targeting. So if you live in Alameda County and you plan to purchase in San Diego County, you're relocating, you would need to look up the guideline for your target area. And so here in Alameda County, the income guideline, and this is for everyone on the loan application, $234,000. I'll just highlight some of the areas that we work in. Contra Costa is the same as Alameda County. And this will be your gross income. And then San Francisco is consistent as well, but where we see a difference is in Joaquin County. It is more conservative, 158,000. And then Sacramento, we do a bit of business there, is at 180,000. So this information is available to you on the CalHAFA website. We will again look at your gross income. If you have any questions about that, you want to connect with a CalHAFA approved lender and get pre-approved and discuss your specific financial scenario.
So what it looks like, Brenda, is that similar to last year, it's only the person that's on the application. So if someone is married and the spouse is not on the loan application, it's not household income, but it's actually gross income of the reported income on the loan application?
That is correct. If there are members of your family that will be living with you in the house that you purchased, but we don't use them to qualify, then we do not have to count their income. The trade-off there is the more income you have, the more your buying power. So if you can obtain the property that you're interested in or the purchase price that you're targeting with your single income or solo income, then feel free to do so, because having more income can disqualify you from the assistance. So oftentimes what I will do with clients is we'll have both parties submit and we see what's best for them. So we'll say, hey, if we have both of you, we can do this program, but with just one of you. So we'll present all of your options. So if you're interested in buying together, but you don't want it to be a barrier to taking advantage of assistance, just talk with your lender and they'll give you guidance and scenarios.
Thank you for that.
You're welcome. So now we know what is required from us regarding our, first-time home buyer options. We know our income. So now I'm going to get a little bit into the credit score requirements and then what that shared appreciation looks like. So we talked about that you must be a first-generation home buyer, but obviously you need to be a California resident. So this is only available for residents of California. And then the occupancy here, all borrowers must occupy the property as their primary resident. And I really want to highlight this because oftentimes we get clients who want to invest, they don't currently own, and want to take advantage of assistance to purchase investment property. With AI, we've seen an increase in banks cracking down on mortgage fraud. So just make sure that you do occupy that property within the 60-day requirement, because they are using AI to identify ownership and occupancy. You cannot have a non-occupant co-borrower. So oftentimes, if a client does not meet their target buying power, we can bring someone on to the loan to subsidize their income and to qualify at their target. If you're not residing in the property, you cannot co-sign or be a non-occupant co-borrower. Now, this is an important component here, the term. At repayment of the principal and any share of their appreciation, the loan is due. So that means that if you transfer title, you sell the property, you pay off the first loan, or you pay off the subordinate loan principal balance, refinance the loan, you have to pay back what you received from CalHAFA plus 20% of your appreciation. And I'm going to model what that looks like a little later in our presentation. But you want to be in close communication with your lender before making any moves, because it could trigger a payoff to CalHAPA.
Brenda, I heard that they were talking about allowing one refinance without the payoff of the equity share if they're not pulling out cash or just doing a rate and term refinance for lower interest rate. Have you heard anything about that?
That is a consideration, and I've done lots of CalHAPA transactions, and when rates dropped significantly about 4 years ago, they did do an exception to where you could do a rate and term refinance to lower your interest rate. And so I do believe as we see interest rates improve, that we will see that exception again, but I am conservative and want clients to know that there is always a possibility. And the way that the guidelines are written today, it says refinance of the first loan. So yes, we can and likely will see some exceptions, because with down payment assistance programs, their intent is to support and assist first-time home buyers. And it's not logical for there to be a restriction in your interest, improving your situation. And refinancing to lower your interest rate lowers your monthly payment, gives you more cash available, so it doesn't make sense. And so I do believe that they will allow a refinance, especially when this program is dropping at a time where interest rates are historically high. So I agree with you. It's likely, but we will notify our clients if we do see that amendment to the guideline, and it will likely come once interest rates start to improve. Now, there are some tiered guidelines associated with the repayment and the shared appreciation piece. If the borrower is in a lower income bracket, and they only pay or share 15% of their equity. So here, if you're over the area median income, and I guess since I've been showing all the other tools, I'll show how this one works as well. So how we determine what the area median income is for the different counties is we actually come to the Fannie Mae website and put in a specific address. Let's see. Okay, so it was gonna be down. For some reason, it's not letting me model it right now. I see a notice that their system was gonna be down, so maybe they're having issues for maintenance. But what happens is once you put in the address, typically the area median will come up. It's not necessary that buyers do this, but oftentimes your loan officer will do it on your behalf, but when you're under the area median income, you receive additional benefits, and other programs are available to you. So that is why that is important. Sorry, I lost my place. I'm just gonna go. I think I closed out of the wrong page. Give me just one moment. Okay, perfect. Oh, and it took me right back to where I was. Sorry about that. So here is the Home Ready lookup tool. So basically, again, if your income is under the area median, and I believe the area median for Alameda County, just off the top of my head, is around 150,000. It will double check that number, but I believe it's in that ballpark. So if you're in that scale, then you only share 15% of your appreciation, as opposed to those who are over the area median income will share 20% of their appreciation. So let's get to the samples of what that looks like. So here, the original shared appreciation loan is 100,000. The original loan times 2.5, so we're getting 250,000. So here, the maximum amount due at the time of payoff, because they do cap how much equity that you can pay CalHAPA, so here it's showing that in this scenario, the maximum payoff will be $350,000. And it will be determined by the lesser of the sales price or the original appraised value. And example number 2, the borrower is above the area median income. They purchased a $500,000 property with 20% down. They got $100,000 from CalHAPA. Later, we'll say 5 years later, they're selling the property and it's now valued at $700,000. So they have $200,000 in appreciation. 20% of that is $40,000. So that's the shared appreciation that CalHAPA is going to receive, plus the $100,000 that CalHAPA gave towards down payment. So the borrower gives CalHAPA $140,000 of their sale proceeds. And then they take the remaining, they keep the remaining. This one thing that you'll want to discuss with your agent is the appreciation rates, the normal appreciation rates in the areas that you're targeting. And you'll want to monitor that. Here is the criteria for someone who's under the area median income. In this instance, someone purchased a property for $400,000. They got 20% from CalHAPA. So they used $80,000 of down payment assistance. When they went to sell their property, the property was valued at $600,000. So that means they have $200,000 appreciation, right? It increased by $200,000 over time. They're going to only have a factor of 0.75 because they are under the area median. So they're not going to share 20%, they're only going to share 15%. And so this borrower only has to recoup $30,000 plus their initial $80,000. And so that's $110,000 that's owed to the program. And that $110,000 goes back to help other borrowers to take advantage of assistance.
Oh, that's good to know.
Yeah, it funds the program. So the loan to value, basically you can purchase a property without no out of pocket. So this 105 covers your down payment and closing costs, but the most that a borrower can contribute is 5%. So that is what this means, that you can bring in your own 5% towards the transaction. You must be working with a approved lender. There are minimum credit scores, so you have to have a 680 credit score, and then they'll allow you to go up to 45% debt to income ratio. And again, when we're looking at your debt to income ratio, we're looking at your gross income. But if you have a 700 credit score or greater, you can qualify for a higher purchase price. And with that, you can do up to 50% debt to income ratio.
So
And
Brenda, can I ask a question really quick? What would you recommend? Let's say somebody is teetering around a 670, 675 mid FICO score, and the portal hasn't opened yet, and they need to get to 680. Is there some tips or advice that you would give to that home buyer?
Yes, thank you. Great question. I have a scenario just like that I'm working right now. So my borrower is right at 678. And so when I pull credit, it gives me a recommendation of what the borrower can do to improve their score. So this borrower in particular just needs to pay down some debt. But I recommend that everyone watching monitor your credit score, because if you're using Experian, Equifax, or TransUnion monitoring tools, they have a mobile app, all of the different bureaus, so you can download it on your phone so that you can always know what your score is, and it will give you suggestions to improve your score. You want to get your information from the source. And so in this instance, it told me that the borrower just needs to pay down debt, but the mobile app will give that information to the consumer. So do not use Credit Karma to track your credit score, because the lenders have not adopted to using Credit Karma. So oftentimes clients will come to me and say, hey, Brenda, my credit score is a 900. And I'm like, wow, I've never seen that in my career. It's because they're looking at Credit Karma. And oftentimes when I pull the FICO scoring system, Fair Isaac Credit, I forgot what the O stands for, but the FICO credit system, it's inconsistent with what's in Credit Karma. Typically, Credit Karma is a lot higher than what we see. And so when you're using, just say Equifax, for instance, it will tell you your mortgage score, your, if you were buying a car, because each vendor models or calculates your history a little bit different. So it's important that you're looking at the vendor type for the application that you plan to submit. So if you're going to buy a car, you want to be looking at your car score, excuse me. And if you're looking to buy a house, you want to make sure that you're looking at your mortgage score, and you'll have less variances. So you look at your score online, then you call me, it should be within the same range. So yes, definitely monitor your score. But if you're not ready today, still call a lender, because they can give you suggestions on what to do. So my client, I told her, pay your credit card down by $200 by the time the lottery window closes. That's what we should talk about, the date for the lottery. The lottery, or actually I'm gonna back up. One, so you qualify using all of the criteria that I shared today. The next step will be for you to reach out to a lender to get pre-approved. That lender is going to give you a letter. Let me just see if I can find a copy of it. But the pre-approval letter doesn't come specifically or on the lender's letterhead. There is a CalHFA letter that needs to be completed and signed by the lender. Here's the link to find the approved lenders, and I'm just going to show you a copy of the letter that you should expect. I'm sorry, it is here on the site, but you're going to get a letter from the lender. The portal opens on April 3rd. I believe the window is from April 3rd to April 28th. So you can submit your confirmed letter within that time period. Once it closes after the 28th, at that point is when the lottery will begin, and they will start notifying those who were selected that they can start shopping for a home. You have 90 days to find a property before they go on to the next person. So it's very important that you have your credit score to the targeted ratio, 680, 700 before April 28th, because you want to be able to submit for the lottery. So you can still get pre-approved. Like with my borrower, I just said, hey, if your name is called, we won't be able to move forward if you don't have your credit where we need it to be. So you do have some flexibility. I don't know that every lender is giving that flexibility, but because it was realistic for her to just pay off $200, and I saw that she had the funds, we're just going to do a rapid rescore to make sure that she's in position.
Great information. And so just to kind of recap, you're looking at the middle score of the three, Experian, Equifax, and TransUnion too. So that's why it's so important to download all three of those bureaus, right? To track all three so that you can get an idea, because that's another thing when some people will tend to only track one score, and that may not be the middle score. It could be the high score, it could be the low score, right?
That is correct. So if you were to use the mobile app from any of the three bureaus, they allow you to see the other bureau scores within their app. So you always
Okay.
want to view that. I believe that sometimes when you're accessing all three bureaus, there may be a fee. I think that I have experience, I think it's like $25, but it's definitely worth the money. And those apps do have, they typically have a monthly fee. Now, if you have a credit card, your credit card servicer typically will allow you to see what your score is, and that is great. You just want to make sure that you're looking for the line item that says it's your FICO score. But yes, there's multiple different ways to monitor your score, and correct, Ria, you do want to be looking at the median of the three. Thank you for that designation.
Thank you.
Any questions on the Dream for All program before I highlight some other assistance programs that are available?
We do have one question. May a property have an ADU?
Yes, you can purchase a property with an ADU. We can use the income, excuse me, from the property to qualify if needed.
You can or cannot?
We can, yes.
Oh, okay, great, nice.
We just don't want it to take you over, the allotted income guideline, but yes, we can use that.
Oh, okay. So if you're capped at the 284 income and then they count the income of the ADU and it pushes you above 284, that could disqualify you.
Yes.
Okay. I think that was the only question for now.
Okay, perfect. I will go on and I'm just gonna highlight a few programs, and then if any of our viewers have questions afterwards, just feel free to email me. And my Instagram, if you want to DM me, my Instagram is here on my title. So the Oakland Cow Home Mortgage Assistance Program is specifically for first-time home buyers that either work or reside in Oakland. So that is the criteria. If you live in another city and work in another city and you haven't been displaced from Oakland, you would not qualify for this program. This program is shared appreciation as well. The great thing about this program is you can get up to $200,000 or 30% of the purchase price. It has a second loan, which has an interest rate of 3%. There's no monthly payments on the assistance that you receive, and you can receive 100% in assistance. It does require that you have 3% of your own funds. So while the down payment can be covered from the program, you need to cover closing costs, and they're strict about that. I've used this program quite a bit. The income limits here are based upon the occupants in your household. So the more folks in the home, the higher the income limit. The next program that I want to just highlight is our Daisy and Grow program. The income limit is the area median. It does require a 660 FICO. You can buy a 2-unit property with this one. So that is why I like it a lot, because a lot of clients are interested in that income generating property. Now, Shanoa.
I'm sorry, can I stop you really quick? For single family residence, is that the purchase price or the loan amount for the 2 units of $929,850?
It is the loan amount, and this needs to be updated. It's now this has gone up a bit. And I know this is 766, the new loan limits. But for 2 units, yes, this would be the loan amount.
Oh, awesome. Okay.
Yeah. Here, the Shanoa program is the FHA program. It allows you to have as little, a credit score as low as 600. There's no income limits on this one. It does not require that you are a first-time home buyer, but you must reside in the property. So it has to be your primary residence. So there's some flexibility there, but it is an FHA program. And this number is a little higher. You can go up to 1.1 with FHA, and their conventional is 760. CalHAFA. So while we focus on Dream for All, which is a CalHAFA product, CalHAFA has other programs, and I bought my first property using CalHAFA, so it's been around a long time. One caveat with CalHAFA's other programs is the interest rate is typically higher than the market rate. So it sometimes impacts your buying power. But they do have programs that will give you up to 6% assistance on the conventional side and 6.5% assistance with FHA. With their My Home program, it has a silent second. So there is a loan. Most of the programs that I've spoke about today, I think almost all of them are either loans or they have the shared equity. This one, the Shenoa does have a forgivable grant component. So grant means you don't have to pay the money back, and you typically want to look for a program that has a grant because who doesn't want free money? So what we do at my firm is we give you a comparison. We look at the different programs on your behalf to see which ones you qualify for, and then we'll present the ones that you qualify for, and we can go over the different options so you can select. And especially with the Dream for All being a lottery, if your goal is to buy a house, let's have it be about buying the house. Yes, we want you to take advantage of the best program, but if your name isn't selected in the lottery, then you have to have a plan B and a plan C. Okay, how else am I going to get this property? So that is why I am highlighting other options so that you know that you have choices in addition to the Dream for All program. The GSFA, Golden State Finance, I like this one as well. They have both conventional and FHA options. They do have a grant component. They'll give up to 7% assistance. They're flexible on the income. They don't require education. There's no first-time home buyer requirement, and your credit score can be as low as 620. Their interest rate is a little higher than market because they use the difference between the market rate and their rate to fund the program. A lot of these programs are self-sufficient, meaning the funds that they receive when you either sell the property or you paying the difference in that interest goes back into the program. And so this is just my closing of don't miss an opportunity to ease on down the home ownership road.
I love it. I love it. Thank you so much, Brenda. Are there any questions? If someone doesn't want to go in the chat and you want to come live on for a question, feel free to do so. And I'm going to bring up our site. But I would like to thank Brenda for sharing this information with us. I know it's a lot of information to take in, and so that is why home buying consultations are so important and pre-approvals are so important, because it allows us an opportunity to address our situation. No situation is different. And we will share how to contact Brenda. I just want to say that if once you do have a pre-approval and you're looking for property, I just wanted to share our website, which is cotton-realty.com. You can find further information on buying and selling. You can check out some of our featured properties. You can also make your own home buying search parameters on our site. You can meet our team and select any one of our real estate professionals to help you through this home buying journey. So it doesn't start at pre-approval for us. It starts at the time where you've made the decision that you will be purchasing a home. So we like to be a part of that journey with you. And so in closing, Brenda, I want you to, if you could just share your information, because we're also live on Facebook. If you want to share how someone can get in touch with you to get started with their pre-approval for the California Dream for All or any of the other amazing programs that you shared. I have to brush up on Chenoa because I'm hearing Chenoa more and more. I used to hear it a long time ago and it kind of phased out. Now I'm hearing it more. So I definitely want to talk to you more about that. But can you share how we can get in touch with you?
Yes, so you can go to my website, financingthedream.net. My firm is LaSalle Mortgage, so you can find me there as well. My Instagram is the.wyatt.team, or you can email me at brenda@lasallemortgage.com.
Great, great. Thank you so much again. And here we go with our another round. It was so amazing because last year we did this same workshop and we were kind of projecting that maybe the funds would go away maybe a 3 or 4 months out, and it went away in 11. It was all sucked up in 11 days. So wow. So here we go again. Exciting times, and I wish everybody luck in the lottery. Thank you. Thanks
Yeah,
for joining.
let's get ready.
Thank you, Brenda.
You're welcome. Thank you.
All right. Bye-bye, everyone.
Bye-bye.